We are going to talk about financial inclusion today and the role of digitization in enabling financial inclusion. Financial inclusion is not really a very complicated topic, so hopefully, but we will have some interesting insights, maybe from me and from our very esteemed panelists today. So what is financial inclusion really about? Accessibility and availability of financial services to all segments of our population. And what kind of financial services? We can break the financial services into 4 verticals: access to savings, access to credit, access to insurance, and access to payments technology. Now, some part of my talk will focus today on savings accounts, the role of payments and credit, not so much on insurance. Some of my colleagues have done very good work on insurance, but that is a understudied market, especially when it comes to insurance penetration among the marginal and underserved segments. Now, why should we care? For industry folks, there is obviously a huge untapped market out there. Even today, 82% of Indian population is credit underserved. So either they have never received formal credit, or at max they have received formal credit only once. And for policymakers, inequality is a big policy issue around the world. And access to financial services is one of the most potent tools in which allows us to bridge this inequality gap. So not surprisingly, over 60 countries around the world has financial inclusion as a key reform agenda. It is mentioned in 7 of the 17 United Nations Sustainable Development Goals. My today's talk is going to focus on access to credit. And in some sense, it is the journey of India over the past couple of decades. What has worked, what doesn't, and then we will have a discussion on where do we go from here. So let me start by giving a big picture view on why access to credit specifically is going to be important and why it affects economic development. The simple idea is that a large fraction of low-income individuals, not just in India, but around the world, are not able to access credit. Why are they not able to access credit? Because they don't have a credit history. So if they don't have a credit history, lenders face information asymmetry. They don't know how to evaluate the risk of this borrower, so they can't give them a loan. Now, if you can relax this credit constraints, what does it allow them to allow people to do? It allows them to invest in productive ventures. Productive ventures meaning their own capital, their own human capital, their education, their health, but also exploit small business opportunities. So if we could relax these constraints, we would see more investments flowing into, hopefully, into education, health, physical investments into small businesses that can foster economic growth, that can reduce poverty and bridge the inequality gap. That is the big promise of financial inclusion. We may not be there yet. So I'll talk about very briefly, about 3 of my research work, starting with Jan Dhan Yojana, what impact it has had, then looking at alternate means to assess creditworthiness for individuals who do not have a financial history, and then bridging the gap between these two is where UPI is going to come in. UPI enabled real-time creation of financial history for a large part of our population who were earlier transacting outside the system. Does it interact with the Savings for All Jan Dhan Yojana program in expanding access to credit? That is the broad overview. So let me jump right in. The first part of my talk is going to focus on bank accounts for all, the PMJDY, Prime Minister Jan Dhan Yojana initiative. It is co-authored work with a bunch of scholars from around the world. And a key fact is that in 2013, about 2 billion or 2.2 billion people around the world, adults, did not have bank accounts. That number has come down to about 1.4 billion, according to the latest estimate, which is a couple of years old from World Bank. And a large part of this drop is driven by the PMJDY program. But even so, 1.4 billion adults, even today, lack bank account access around the world. So one question is, can these large-scale financial initiatives help? And if you launch such large-scale financial initiatives, does it really increase bank penetration? Is it only bank accounts being opened, or are people really using the bank accounts? Is it really solving some problems? So we start by looking at very detailed micro-level bank data on the initial adoption and subsequent usage of these programs. Then we try to figure out what are the determinants of this usage and how does this usage evolve over time to understand whether and why such access to savings technology may work. Now, one could argue that because many of these people are low income, by design, they may not have financial savings. So access to a savings account may not do much for them to begin with. So we will also look at whether the savings accounts enable these people to have greater insurance coverage or greater access to credit as well. going into this study, we were quite optimistic that this is a large-scale program. A large part of the population is getting access to savings account for the first time. And so we were hoping that this will also lead to large-scale jumps in access to credit and insurance penetration. And there the results are going to be a little bit depressing. It did not really happen. To be able to assess larger impacts of the program, we obviously would have loved to have data on individuals and what they are doing with savings account, and which is part of the reason of organizing this ISB Insights Forum. One of the reason is to showcase what the faculty here is doing, what kind of problem they are working on, and hopefully encourage people from the industry, various banks, etc., to share data that can enable us to create more research, create more novel insights that future generations can learn from. So because we did not have detailed consumer level data, what we do is we use consumer pyramids and we look at regional level outcomes for analyzing whether savings account leads to any welfare for the broader economy. So just some summary of what we find. So of course there was a large uptake in terms of people getting access to first time bank accounts. About 77% of these bank accounts maintain a positive balance. So it's not like everybody is all zero balance account. There is some savings in many of these accounts, although small from our perspective, may be large enough based on the income that they generate. Now, in what regions is this bank accounts more heavily used? So that part is reasonably interesting. Regions that were more prone to thefts, more prone to robberies is where the uptake is higher, where the usage of these accounts is higher. We also learn that we also find that individuals learn to use these bank accounts over time. So if we were looking at only short-run impact or just a shorter time frame, that may not be sufficient to understand whether such large-scale financial inclusion programs can have real effects. The real effects will take longer to manifest as more individuals learn about the benefits of this access. So in terms of what kind of positive effects it has had, one thing, there is a fancy term in academics called consumption smoothing, which simply means that people save during good times and spend these savings in times of health shocks or income shocks, allows them to reduce uncertainty in their consumption, uncertainty in their lives. So the first headline finding is in terms of welfare, we do find that the savings behavior of people change. People save during good times and they spend during bad times. There is also some increase in access to credit, particularly insuring people against bad shocks. And one measure of such bad adverse shock, what we use is rainfall. So in regions, especially agriculture regions, if it's adverse rainfall period, people are able to access credit then. So there is some increase in access to credit for people who did not have access to credit earlier, but this increase is very marginal. Now we got data from one of the largest public sector banks in India on about 1.5 million accounts. Out of these, about 3.5% of these accounts have actually gotten some credit. So it's in absolute terms, it will still be a big number. 3.5% of a large population is going to be big, but in percentage terms, the uptake is still small. Then when we focus at the regional level, we do find some increase in lending, particularly to deal with health shocks, not for education and business purposes, but particularly to deal with health shocks. Now the question is that we went into this with all this promise that you give people savings accounts and all sorts of good things will happen, access to credit will go up. That did not really happen. So that got us wondering, what can we do to bridge this gap, not just in savings technology, but also access to credit? And so the question was that obviously the key challenge again is that the lender faces information uncertainty, information asymmetry about the credit worthiness or the default and repayment risk of the borrower. Is there a way to bridge this gap for people who do not have a financial history, who do not have a credit history? Clearly, savings account is not enough because a large fraction of the population who are getting these savings accounts, for banks, there is no credible way of verifying their income because they may be operating in the informal sector. So can we bring in alternate data streams and change this? So that was what motivated the second study. The big picture, again, headline statistics is even today, about 850 million individuals in India are credit underserved. So either they have never received formal credit or they have received credit only once. Now, many of these people could be good borrowers, what we call invisible prime borrowers, if we could somehow access their credit worthiness using alternate means. Why is it important? Because as I mentioned earlier, people cannot access credit. There is some loss of productivity in the economy. They cannot invest in their education, health, grow their businesses, etc. So how do we expand credit to the underserved segments? Now, one potential solution is that while a large mass of Indian population and world population have never taken credit, many of these people who have never taken credit do have internet access. So while they don't have a financial history, they are creating digital histories, digital footprints in real time based on how many people they call, the social network, what kind of apps that you have installed on their phone. There are some researchers who have used this mobile phone data, simply the call logs data, to figure out the wealth distribution of the entire economy. So there is some promise in this data. So there is an overlap between people who are potentially creditworthy, but today lack a financial history, and people who have a digital footprint may not have a financial footprint. The question is, can we bring it together? Can we create a credit score? Now, the challenge is the following. If I don't have a credit history, I apply for a loan, the bank or the financial intermediary pings the credit bureau. They ping the credit bureau, they find that I don't have a credit history, so they deny the loan, and I'm stuck in this bad loop. Now, we bring in some sort of alternate data. It could be call logs, could be tax filings for firms that have been formalized, for individuals, payments data, the social network data, e-commerce transaction, etc. And we build an alternate credit score. Now, we assess the credit worthiness of individuals using this alternate data stream. They get a loan, let's say from Rangde. Once they get a loan, now they are part of the formal credit history. So now they are part of the credit bureau. So they move from this depressing cycle to hopefully a virtuous cycle. And the economic motivation is that we are reducing information asymmetry in terms of the ability of the borrower to repay. Now, what do we find? That this digital footprints, very simple metrics, like the number of people you call, the structure of your social network, the depth and breadth of your social network, does a remarkable job of predicting default risk for the segment of borrowers who never had a credit history. Now, to build this model, we obviously first focus on the segment of borrowers who are high risk but have some credit history. So we have some data to train our model. And then we apply this model to people who don't have a credit history but have all this alternate digital data streams. And for this, we worked with a large fintech, which is now a large fintech firm. When we started working with them, they were just entering this space. Now they have become reasonably large. And using this alternate data model, they were able to approve 17% more loans among the set of borrowers who lack credit history. Now, the question is still that yes, there was a part of the segment of the population who did not have a financial history, but they have a digital history. What about another segment which may not even be digitally excluded? If you are digitally excluded, then you don't have digital data. Again, we are back to the same problem. And this is where my third study is going to come in, which is titled Open Banking and Digital Payments, Implications for Credit Access. It's really a study of UPI and the open data sharing arrangements possible in India as of today. We have a long way to go, but it has started. UPI is one of the earliest implementation of an open banking platform. What is an open banking platform? So I own my data, I own my capital, I own my money. So while I may be saving in a particular bank account, I can transact using third-party apps across multiple bank accounts, or more importantly, I can share my financial history, my transaction data across all sorts of banks and all sorts of fintechs. So why can UPI be beneficial? So for people who did not have a financial history, who were transacting in cash outside the formal economy, now they start using UPI. So think of a roadside kiosk or a vegetable vendor, a panwala. So now they start using UPI. So now they are building a stream of data that helps us understand their revenue cycle, their revenue volatility over time, which now can be used by banks and fintechs to assess their income and consequently their ability to repay. And then you start giving them loans. Now today you go to Google Pay. It's a payment platform focusing on UPI, but you can apply for a loan and get approved for a loan within a matter of 5 to 10 minutes. So what did UPI really do? It enabled real-time, costless for customer. It does cost the bank and the architecture something. Creation of a digital financial history. Where is open banking in all this? Customers, in principle, own their data, and Mrinalini will have some thoughts on whether they really own it or not. And in principle, they provide consent to share their UPI transaction history across banks and fintechs, and then banks and fintechs can potentially use it to start giving credit. The question is it really happening? So what are we going to focus on? Did UPI lead to a large-scale increase in access to credit? If so, for whom? Is it really expanding credit only to people like us? Maybe because of convenience, maybe because the cost of providing small ticket loans has gone down, because of India's tax, and the cost of acquiring and screening customers has gone down, enabled by digitization. Or is it really expanding credit to the marginal and underserved population of borrowers? Then if so, who is facilitating this credit? Are these our traditional banks, or is a large part of credit led by fintechs? What we will not be able to do is focus on where is this credit flowing into. Are people borrowing for consumption or really for productive investment? Because unfortunately, we don't have that data. But it's in my view, it's a start, and it's a good start. And I'm mentioning a large data exercise here only because I want to motivate some industry participants here that good research, good policy needs to be backed by good data, and that requires partnership amongst policymakers, academics, and industry. It took us 3 years to just put the data together. So we have the data on universe of unsecured consumer loans from a credit bureau in India, probably the first research paper across the world to have the universe of consumer loans. We also got UPI data at the PIN code level, both on the volume and the value of transactions across India. Then we have bank branch deposit data, which is maintained by RBI but not publicly available. We have the number of Jan Dhan Yojana accounts opened across PIN codes from Ministry of Finance. We have the opening of 4G towers across India from the Telecom Authority of India. And we worked with a small, not small, a reasonable sized fintech firm and got detailed micro level data on what this fintech firm is doing. So we will show some aggregate effects, but is it really true? For that, to validate it, we will use this fintech firm as a case study of what happens. So I will only present a summary of my findings. At the aggregate level, what we find is a 7% increase in UPI transactions at the PIN code level is associated with 10% increase in credit. Now the challenge is that this is all correlation. It is possible that PIN codes that are doing well economically, where real economic activity is growing, they also do more transactions, they also have more access to credit. So a large part of the research that we do within ISB and across business schools around the world is to take a very careful approach in improving cause and effect. Now I'm not getting into those academic discussions. So while we are presenting correlations here, a lot of effort goes into our research in trying to prove cause and effect. I will not get into those discussions. Now, finally, where is credit flowing? To what kind of borrowers, and who is enabling this credit flow? So in the blue line here is all the banks put together, both public sector banks and private sector banks. And the red line is the fintechs. And I'm not focusing on value, although we look at value in the paper as well, because in terms of value, this unsecured market, small ticket, new to credit market is still very low. But in terms of the number of people served, what we find is within a short span of 4 years, the number of new to credit customers served by fintechs is collectively equal to all the banks put together. And remember, all these banks have been existing for a while this fintech is new. And that is true for subprime segment. That is true for the new to credit segment. If anything, if you focus on banks, credit flow to subprime segments and new to credit segments have largely remained flat. Now, in terms of prime borrowers, people like you and me, there is an increase both by fintechs and banks. So banks have leveraged UPI to expand access to credit, but maybe to existing prime borrowers, while fintechs are leading the way in expanding access to credit, to new to credit, and the subprime segments. Now, summarizing the findings, we find that credit markets expand due to UPI. In particular, there is an increase in credit flow to underserved categories, new to credit borrowers and subprimes. And there is a big debate around the world whether fintechs compete with banks or collaborate, or whether they expand markets. At least in this setting, we find that there is some market segmentation. Fintechs early on were expanding access to credit to the underserved segments, while banks were primarily focusing on the prime borrowers. And there is a combination effect between Jan Dhan Yojana accounts opened earlier. We find that a large part of this credit increase, especially to the new to credit segment, is flowing in regions where Jan Dhan Yojana accounts were open, and is flowing in this credit increase happens post the launch of Jio, when the cost of 4G came down from about 270 rupees per GB to 10 rupees per GB. Now UPI usage requires digital inclusion, low cost internet enables digital inclusion. So here is some evidence showing that digital inclusion can lead to financial inclusion, solving part of the problem that we ended the second research discussion with. How do we expand access to people who were earlier digitally excluded? So credit goes up for underserved segments in regions where more Jan Dhan Yojana accounts are opened and post the cost of internet access going down. Overall, we conclude that open banking-based public digital payment infrastructure aids broad-based credit access. Thank you all for listening to me, and we will now have some discussion with our panelists. But I'll start, because I'm biased, I'll start with our own alum. I'll start with Mrinalini, and then I'll go to Sreehari Garu and Arun Garu. On your thoughts on the challenges going forward in barriers to financial access and the opportunities as well. And you have some, because you're working with a very innovative peer-to-peer lending platform, you also have a very different perspective on some of these issues.
Okay, so the question was barriers and the opportunities.
Yeah. Or the challenges, not barriers, but challenges.
Okay, yeah, thanks. It's lovely to be here. And I'm actually happy that, Bhagwan, you're not here. I would have been really intimidated. But because, once an alum, you're always
But Bhagwan is everywhere.
That's true. So again, I'm a development sector professional, so I have a development perspective on these things. And when we say underserved, for me, it's typically borrowers who don't get to exercise agency. So there are two points that I just wanted to bring out. I think it's fantastic that we now have a digital footprint. It's great that we are moving towards alternate underwriting models, if you will. So traditionally, so the framework is typically that you have folks like he pointed out, folks who don't get loans, will not get loans, will never be able to prove that they're creditworthy. In the traditional way of looking at underwriting, do they have collateral, do they have credit history? Essentially only 2 data points. If you're trying to expand that to say now, do they have GST filings or do they have, unlikely, they usually have a credit history if they have GST filings, but UPI data and the rest give you a lot more information, which is great. I think that's one of the opportunities. But when we build for the underserved, I think there are 2 or 3 things that are very important. One is empathy. I think we are working with people who have never borrowed, who probably do not exercise the levels of financial literacy that we do. And I can say with confidence that 50% people in this room don't know how their credit cards work, in spite of all of our education and opportunity and access. So now you're talking of someone who probably doesn't have this level of financial literacy and therefore may or may not be making a choice to take this loan. And that's what I call agency. So to me, it is financial literacy, it is agency, and it is really the ability to choose and choose with the right information. The entire data footprint we are talking about, and we've had a conversation about this, is really supporting the lender's ability to reach out to more borrowers, right? Which is great, which is what part of the economy does. But we have to stop looking at the underserved as an opportunity to make that extra margin, right? I'll stop here. I've got several thoughts about this. But essentially, I think the challenge is that we lose out on empathy and we lose out on looking at borrowers as individuals who have several more constraints than, so the inequality in that equation, it's so stark, right? So we have to take those into account. That's a challenge. But if we were to overcome that, all of this alternate data, and when we're talking of ULI or OKIN or all of that, will actually empower the borrower if we set it up for the borrower to be empowered. I'll stop there for now.
I'll come back to you because I promised I will disagree a little bit. If all of us could be empathetic, I think the world would be a better place, but I don't think we are getting there without incentives. Sreehari ji,
yes,
you have led some of these initiatives in your banks. The public sector banks are obviously at the forefront of financial welfare. So your thoughts on what banks are doing, where is it headed, how digitization has enabled some of the things that banks are able to do today to serve some segments that they were not able to serve earlier.
Certainly, sir. So thank you, Mr. Shashwat. And In fact, I feel very fortunate to be part of here as part of the panelists. So I'm Sreehari, AGM representing the state level bankers committee. In fact, State Bank of India is the lead bank in the state of Telangana. So by virtue of that, we are carrying the responsibility of carrying the SLBC. As the major discussion here is getting confined to the credit exposure, credit sort of thing, how to get the credit linkage. And in fact, as Ms. Shashwat was saying, all about the financial inclusion, it carries certain parameters like how the uncovered the people who are deprived of the financial facilities are getting connected. In fact, the first step is getting them connected to the PM Jan Dhan Yojana. In fact, government has come out in somewhere in 2014, where a sort of massive crores of accounts are opened by all the banks, PM JDY accounts. But the second leg of the financial inclusion is getting them connected to the credit linkage. So for that, in fact, the government started with the Pradhan Mantri Mudra Yojana, PMMY was the next step. Of course, apart from that, there are various other schemes which I'll be, how we are moving, getting them connected to the credit linkage also, I'll just briefly touch upon, very briefly touch upon. And in fact, the third part is, as you were saying, once I have a banking facility and once I got my credit linkage, my next step should be, suppose I started carrying my business. The third step should be, I should be insured also. In case of any eventuality, if something happens to me, if I am the key earning member of the family, my business should not get halted, family should not be on the road. So there comes the requirement of getting covered under the insurance products also. And that necessitated, in fact, in the same similar period, like in 2014 and 15, Government of India have come out with Pradhan Mantri Jeevan Jyoti Bima Yojana for life insurance coverage, and also Suraksha Bima Yojana for accidental death also. So apart from, once I'm insured, yeah, I'm comfortable, my family is safe. And suppose nothing happens to me, no casualty takes place for my life, and if I reach the age of, let us say, the superannuation, maybe the 60, where I just opt to retire, so there should be some regular source of income that necessitated to come out with Atal Pension Yojana, so a pension scheme. So all these together they are forming sort of components of the financial inclusion as such. So once we talk about the credit exposure, maybe organized sector and unorganized sector, if we look at both are playing. I'm not saying the fintechs are not part of the unorganized. They are also with a license that they get from RBI. But what from the public sector and the bank's point of public sector or the commercial bank's point of view, the private sector and RRBs, because financial inclusion is not something we started in 2014 alone. Even government came out with a vision of starting the RRBs, regional rural banks. Even the cooperative bank structure, even the primary agriculture credit societies were started. Tax farmer service societies were started.
SHG.
So the SHG movement is a very, maybe immediately after the success story of Bangladesh. In fact, we just adopted that concept, and it's a wonderful story that we are getting, the benefits and the fruits of that movement, we are really experiencing that. SHG movement, it is evergreen movement, in fact, I can say. So coming to the credit exposure that we go with all the commercial banks as such. So there is a structure, there is a methodology which we go with. In fact, any loan that bank gives, any bank which gives, we go with a need-based assessment of the credit requirement of the borrower. The person who is the recipient of this advance, we make some need-based assessment. But let us say the country as a whole, the state as a whole, how this assessment is made. So here comes the role of the NABARD, National Bank for Agriculture and Rural Development. So NABARD will conduct the ground level survey, starting from the joint mandal level bankers committee will be there. At the district level, again the DCC's district consultative committees are there. So NABARD will conduct the potential credit link, credit assessment is carried by the NABARD, and they will come out with a potential credit plan they release, and basing on that, on behalf of all the banks, SLBC will prepare what is called the annual credit plan. ACP will release, like for 2024-25, we have released the annual credit plan somewhere in the first week of May. This ACP is totally based on the potential which is assessed by NABARD. So we'll bifurcate this annual credit plan among the banks. All the banks are functioning in the state, for example. Branch-wise also it is bifurcated. So what is the need and how I need to assess, how I need to achieve that. So at the, we'll have the regular reviews, quarterly reviews are carried, all the banks will sit together. What is my target and where exactly I am standing? In fact, on the other side, the Government of India, the Department of Financial Services will be there, where even the Government of Telangana also will be there to review the performance of the banks. It goes like that. Over and above this, like we release the annual credit plan for the year. After some time, after 2 months, Department of Financial Services, that is Government of India, they came out with the ground level credit report. They assessed on their own. Government of India assessed the credit requirement at the ground level, and which is substantially more than what NABARD assessed. So we were forced to change our entire credit plan for the current year. So then we have amended that figure, and now we are reviewing the banks basing on the ground level credit. There is a structured system that we go with the assessing. And apart from this, in fact, we have the saturation programs which are announced by Government of India from time to time. Like DFS is, for any program for that matter, they come out with a mission mode. For KCC, if we take the Kisan credit card, there are KCC saturation drive in respect of the KCC loans. Like we have the PM Kisan program also is there, KCC outreach program, and KCC dairy development for Animal Husbandry Department also is involved. We'll have a regular review from the Animal Husbandry Department, Government of India. So KCC, like every week, there will be a review meeting which happens at the district level. Lead district manager will be there representing all the banks. The Animal Husbandry Department will come. They will have the saturation drive. Applications are sourced. The need-based applications are sourced from the ground level, and these applications are given to the respective banks, and they will either sanction the loan basing on the eligibility, or they will reject the loan. So there is a structured process again. So there is a review mechanism. Even for KCC fisheries outreach programs are there. Apart from that, the PM Mudra Yojana, you take Pradhan Mantri Mudra Yojana, again it is bifurcated into 3 products, Arun, starting from up to 50,000, 50,000 to 5 lakhs, and 5 lakhs to 10 lakhs. And very recently in the current financial year, the finance minister has come out with a novel idea of enhancing it from 10 lakhs to 20 lakhs. There is a new layer called Tarun Plus. Whoever has rightly paid this, we are going for Tarun Plus. And if we take the PM Vishwakarma loan, in fact, this was launched last year by the Prime Minister, PM Vishwakarma, or Pradhan Mantri, in fact, Swanidhi we call it, street vendors, Atmanirbhar Bharat. Even 10,000 loan is given to the street vendor. 10,000 is a very big amount. Absolutely, like even for PM Vishwakarma, we don't even ask for the quotation. Up to 1 lakh, banks can directly give this 1 lakh. And all these loans, whatever I talked about, even many other loans, there are something like 24 loans which can be applied by the beneficiary directly through an app, like Udhami Mitra portal is there. So gone are the days where the beneficiary will approach the bank and the borrower is made to move around the bank for so many times. Absolutely, there is no such situation now. They can directly apply, they can choose the bank, choose the branch, and directly that gets escalated. Like PM Vishwakarma, there is a structured program. Everything is technology based now. The platform is so designed. DFS is continuously working on this platform, and different line departments, they have their own platforms for this technology. Technology is totally leveraged to make entire thing very user friendly. And as I told you, these 24 loans can be applied by the beneficiary through this Udhami Mitra portal. So that is one thing. And everything has got the SOP part, the TAT part is there, turnaround time. So anything pendency for more than 30 days, the banks, the neck of the bank will be held either by the SLPC or by the respective bank controllers. So everything is answerable. The banks are answerable. Credit is happening. Very absolutely, sir. The credit is happening. And like street vendors loans, like first if they pay 10,000 rupees within the stipulated time, they are eligible for 20,000 automatic. So the tranche 2 is 20,000, and once they repay successfully this 20,000, they are taken to the 50,000. And once they repay 50,000, then they are eligible for Mudra loan, 50,000, maybe up to 2 lakhs, maybe up to 5 lakhs. And let us say PM Stand Up India scheme. It is another flagship program of government, up to 1 crore without taking a single security. In fact, this is backed by the CGTMSC, credit guarantee coverage. Not even a single member of the family need to come and give the guarantee for that, and no document, no property document is required for that. It's a wonderful scheme again. SC, ST and women, they are eligible for this. And there is a stipulated target for the branches, like number of branches that bank has got, multiplied by 2 is the simple target for the bank. Suppose we have 6,200 bank branches in the state of Telangana. So all the banks together should give Stand-up India loans to 12,400 beneficiaries. Fortunately, we have Telangana state, we have already achieved 12,400. Maybe some individual banks they have not achieved. Some banks have well exceeded this target also, two units per branch. So a lot of innovative schemes are coming. Lot of say it's something like 24/7 banks are working to reach out, and of course ultimately the credit exposure. It's a continuous process. In fact, just for information, I was at Asifabad yesterday attending the district credit plan where the director from DFS also was there, the district collector was there. So we were reviewing, in fact. So the credit exposure only, we were talking about the financial inclusion and credit exposure. It's a continuous journey. So it's something which never gets halted. More particularly, like PM Jandan accounts in the state of Telangana alone, we have around 1.24 crores of accounts which are opened. Let us say for a population of 5 crores. So I don't say we have reached the saturation level. Absolutely, it's not like that. Currently, on 15th October, DFS they have come out with a drive called Jan Suraksha campaign, going up to 15th January, where we'll be going for the outreach program where these insurance schemes are getting focused. PM JJBY and PM SBY. We have to conduct the camps at the Gram Panchayat level, even at the villages level, and we need to cover under the insurance products. It's a continuous journey, sir. Yeah. So with this, I just halt, sir. Anything
I will interrupt you here on the point of we have not reached saturation, and maybe I'll pivot to Arunji. So there are so many initiatives, that sir talked about, like hundreds of initiatives. These are not novel. This has been in India for like many years. We have had regional rural banks. Why haven't we been able to solve this problem, many years ago? Why do we still have a long way to go? Even today, despite UPI penetration being very high, only 28% of adults in India are really using digital transactions. Why does government need to push banks that you give loans to 12,400 people, come up with Swanidhi, Vishwakarma? Where was it that banks were not able to figure it out? What are the challenges that you face? And how are you overcoming those challenges within Union Bank today?
Yeah, in a lighter vein, see, credit is growing very huge, but deposits are not growing. Now people are investing more in MFIs, sorry, mutual funds. So I don't think credit is not growing, and we are reaching everywhere. Where bank has not reached, we are preparing STP programs where they credentials, they can punch themselves and they can avail the loans. Even for Mudra, Tarun, whatever may be the loan, any loan you take, there are STP journeys for that. Even for education loans also STP journeys are there. So whoever is tech savvy, whoever is digitally little knowledgeable is there, they can read and enter the details and get the loan. And it is a span of seconds, it will be credited. Once your due diligence at the back end where it will be fetch data from UDI. If it is proper, you will get your account opened and disbursed also. No manual intervention is required. Even documents are digitally signed. So I think digitization is driving in a fair way. Even we are reaching unbanked areas where earlier brick and mortar was the more branch level, but now you can bank anywhere in the country. Even outside the country also you are having account, you can transact that by using your net banking or your mobile banking app. So even in mobile banking app also it is your thumb driven. You need not punch, even illiterate can use it. So it is so easy to transfer money and to get the money and to get the loans. In everything, even if you want to invest, your mobile banking app is sufficient. So everybody is having their bank in their hands now. So I don't think financial digitization is need of the day, because a lot of research is being happened from bank side also. IBRDT is also supporting bankers in everywhere in developing these journeys, along with what you say protections for unwarranted usage by the unknown persons. But still, if you even whatever maybe the restrictions are, but utilization of digitization is order of the day, and it is going to be the next level of banking. Nobody is required to go to the bank and complete their needs now. Even from Union Bank of India, we have launched on our foundation day up to 1 crore you can do it through digital means also with under a CGTMSE scheme. So banks are moving in the right direction. Maybe one or other way may be happening. It may be outlier, but still digitization is happening and it is going to the order of the day. You need to live with it.
So, Mrinalini, I'll loop back to you. Sir mentioned something about this AEPS and business correspondence, that you can now use your thumb and withdraw money. That is one kind of innovation which seems quite inclusive. But if we look at least not the UPI Lite, but UPI apps, it seems to be designed for a very literate population. If you look at fintechs apps also, I don't think it's easy for Bhagwan likes to use the example of Kalavati, who works for him, to access GPay or fintechs apps. And you mentioned something about not just technological innovation, but social innovation. Can you talk a little bit about social innovation? And then if you have some time on this empathy versus profits. If I could, I would want all my students to be empathetic, but the world runs on money and incentives. So how do we scale this empathy-based banking model to serve 140 billion people? Right? That is the scale of the problem that we are dealing with.
That's a lot of questions.
Two questions.
Let me first answer the empathy bit. I think because it's a longer discussion, I'll just give a very short answer to it. I think empathy is just fundamentally all of us should have it anyway. What I meant is it's not an either or question. It's really not. Right? We've got a whole social enterprise ecosystem. We've got so many people working at so many different angles at solving social problems with a profit motive. Right? So it doesn't necessarily preclude a profit motive. What it does is to be very mindful of whom you are building for. Right? So to me, to me, intent is really everything. So if you are going to build with the intent of maximizing profit, that's exactly what you will do. And if on the way to that, you are making vulnerable borrowers more vulnerable, you have set up the system for it. This is what I meant when I said structurally, what are you setting up for, right? If you are building to make sure that while you make a profit, obviously everyone has to make a profit because otherwise how will you sustain yourself? While you do that, are you taking into account the real need of the person for whom this is? So whom are you building for is the question to answer really. And that is where to me empathy comes in. So if you want a longer discussion on that, I'm very happy to chat, outside. But coming back to social innovation, and I want to refer to what Sir said, and Arun Garu also knows very well. If you look back to the Andhra Pradesh and Telangana ecosystem, and this is what I am familiar with, to 20 years. So even more, now 25, I guess. So late 90s, right? We were looking at large numbers of what we define as poor people, right? And the largest drawback of the poor was that there were so many of them. How do you now cater to so many poor people and somehow drag them beyond this mythical creature called the poverty line, right? I mean, that was the question back then. Lot of things happened. But the real social innovation, and what you referred to very well, sir, after Bangladesh, was that we turned that disadvantage, the so-called disadvantage of numbers, on its head. And we started the self-help group movement. So now you started getting 10 people together, then 10 groups together, and then you have this whole infrastructure that Sir is talking about. In an SLBC today, the chief minister represents the demand from the self-help groups, right? So from a situation where a woman could not access a loan, here is now a bank manager who has a target to go and sit and give that loan to her. All of this has not happened because of technology. Technology will enhance it. The fundamental thing that drove this is the social innovation of now how do we solve this problem of, at that time it was the numbers of poor. If we were to apply a similar approach to the underserved and credit needs to them, to me, there are two dimensions of it. We have to perceive credit as a means to something. Zariya hai bas. It is a means to an end. So if you're looking at consumption loans, I will not comment on it. I know that the initial savings were for consumption because consumption was not possible at one time. And India is not one India. what Andhra Pradesh is today, or what Andhra Pradesh was 25 years ago in terms of savings, etc., maybe Uttar Pradesh is getting there, in another 10 years. So all our states are very different and we operate at very different levels of consumption and vulnerability. But what are we lending for? Are we lending for livelihoods? I think that was one of the questions you had asked as well. Is it going into consumption? I will guarantee you, in mature, in states where the SHG movement is mature, so no offense, but very often, we used to report 8,000 crores bank linkage. This was in 2015. Maybe now it is more, it is less per year, whatever the. If you are not applying it to a productive purpose, you are very likely to on-lend it. And then you become part of the problem yourself. You see what I'm saying? So the linkage between credit and livelihood is something that has to be very strong if you want this to achieve the outcomes that you want it to. Again, I'll stop there. I mean,
That's a good, yeah, that's a good optimal stopping point in many ways, because that feeds into my next question. And I'll plug in a bit of cool research that I've done on this. I am biased. I think all my research is cool. So we work with this fintech firm in the US. They give small ticket loans. It's a very innovative business model because they don't charge interest rate. They allow you to tip, like we tip in restaurants. And if you look at the tipping amount, it turns out that the annualized interest rate is close to 150 to 300%, which is very similar to what payday lenders charge there. So this is a setting in which the borrower is clearly not vulnerable. Nobody is forcing them to go on the app. They go on the app. They can choose not to pay any interest, but they still choose to tip. And that's, again, a wider debate. What is the appropriate interest rate? But the reason I'm mentioning this is that RBI is obviously very concerned about this uptake in unsecured loan. Can it lead to systemic risk? And that is linked to this idea of, is this loans getting into livelihood? Or is this getting people to consume just stuff for conspicuous consumption? At least you see these videos of poor kids taking their father, taking 1.5 lakh rupees in cash and buying iPhones. Those may be one-off events. The challenge is that we do want to expand access to credit to this large mass of population. We do want to provide them agency over their lives and be able to access this credit. So when RBI comes down heavily on this market, maybe for good reasons, it shuts down that market. So if you look at fintechs now, they are gradually moving away from this underserved segments and back into prime and secured lending and mortgages. So how do we manage this? How do we manage or change our policy making or regulatory environment in a way where we ensure that credit is going to the people who need it for livelihood, not necessarily for consumption, is not leading to debt trap. If we don't solve that problem, then RBI will always have concerns, and then we will be back in this loop of trying to figure out new ways to solve it. So your thoughts on what can banks do, what can regulators do on
So actually, again, here, even going forward with what Madam is trying to say and the question which you are posing now, the livelihood and consumption, in fact, they are the two components of the needs of the borrower again.
emergencies.
Suppose any loan for that matter, bank will be extending for the livelihood purpose. Any business loans or the crop loans or other things, except the personal loans which are given to the employees for the income group for consumption purpose. Even for the farmers, let us say, the KCC loan is clubbed with the consumption needs. We'll assess the crop requirement, like we have the concept called scale-up finance, which is again decided by the state level technical committee, will be decided. Further 10% is added, like let us say for paddy it's 1 lakh per acre, is sowing paddy in 2 acres, the total credit requirement 2 lakhs, at 10%, 2 lakh 20 is fixed as the KCC loan for that particular year. So the consumption is automatically added for that. So that is inbuilt, in fact. Let us say SHG, it's a very big movement of, I can say the 50% of population the comprising of women. I'm not saying all the women are part of the SHGs, I'm not saying. But for SHG loans, for the group loan, we extend for rural SHGs. We have rural SHGs and we have urban SHGs also. For urban SHGs, we can extend a loan up to 10 lakhs. Suppose if it is a group of 10 persons, we can give 10 lakh loan, not for any activity. Straight away, they can take 1 lakh each, they can distribute among themselves, and we don't know for what purpose there is. We bank will not question them. Definitely that may be for the consumption purpose only. Nothing wrong. Banks are prepared. For rural SHGs, they are eligible for a loan up to 20 lakhs. Absolutely, it's a clean loan, not backed by any security, not asked for any purpose of that particular loan. So it's a consumption purpose only. So the consumption needs, even if we take the business loan also, while we'll assess the working capital needs also, we'll definitely take into consideration the contingency needs of that particular business. So they're loaded into the while assessing the working capital requirements. So it goes automatically by default, it is inbuilt into that assessment. Now, in fact, government of Telangana, they have come out with, for SHGs, madam, in fact, so they have come out with a scheme called Indira Mahila Shakti, where they say for individual members, you give loans for some productive purpose. Already whatever we are giving for urban and rural SHGs, that's a different thing. So now they are asking, you try to give the individual loans. Banks are happy to give. We told the state administration also, yeah, they can be fitted under any of the available schemes like Mudra or Stand Up India or any loan for that matter. So already, in fact, such grounding also has happened in the state of Telangana. So individual members. Ultimately, what I wanted to say is, whatever loan that we are giving to any of the needy person, it should not result in the multiple financing. We have to keep in mind that at the back of the mind, what we have to carry is, whether it is from the fintech or from the commercial organization, so the repayment capacity and the credit worthiness of the borrower invariably has to be kept in mind, which normally as a commercial banker, me as a commercial banker, I will always be looking at the person, whether the person can be able to repay at the end of the day. Logically, so at least only, I'll just stop here with only one say. In fact, I was just in our other talk also I was saying, at least as far as my experience was, I have not come across a single farmer, because we have been hearing that so many farmers are committing suicide. Not even a single farmer committed suicide because of the loan which he availed from any of the commercial bank. Maybe stray cases might be there. I have not gone to each village and inquired. If the farmer is committing suicide, definitely might be the intrinsic borrowings that he has carried, maybe from the local money lenders, maybe from the other MFIs or microfinance or anything for that matter. At least definitely, at least I have not come across like any banker went and harassed and they made them to commit suicide. It's not like that. Yeah, yes, sir, please.
Just, can I comment actually?
Yeah, sure.
So I think your question was, what can the government do in terms of regulation in this space, right?
Reducing uncertainty while expanding access and...
Yeah. So one of them is what you are saying, sir, about so currently these are institutional lendings, which is not from banks, right? So non-banking institutional lendings, there is no interest rate cap. I mean, I'd be happy to be corrected, but there is no interest rate cap.
They removed it a few years ago. They are bringing it back in, no?
I hope
Already
they bring
capped.
it back in.
Already brought in.
Right. So that is what the regulatory environment needs to do. Because when there is no interest rate cap, we have this whole narrative, and we are very fond of it, that access is more important than affordability. Right? हमने access provide कर दिया तो मतलब we can charge what we like. Because what you said, right? It's a question of consumer surplus there. They clearly saw that they can pay whatever that amount, the tips that you referred to, right? But that happens when there is agency. When there is no agency and the regulatory environment is focusing on access rather than affordability, or looking at let's lend to more people rather than what we are lending for, right? Or, I mean, everyone knows this, that single families, I think in Uttar Pradesh now there is a ban. The RBI has put out a ban on MFI saying to one family, more than 2 MFIs cannot lend because of a systemic, structural issues there, right? So what we need is a vigilant regulatory environment that doesn't throttle business. You shouldn't. And people who make profit should make a profit, absolutely. And if there are people who are willing to and required to pay 30% interest, maybe there is a case for that. There is a certain segment for that. But what we should not do is to take this to people who cannot afford it, whom we know cannot afford it, whom we know cannot repay. And then you are borrowing from one institution to repay another institution and a third institution to repay the second institution. That is what you are talking about. Multiple loans for the same family.
Actually, multiple financing is happening.
It is happening.
Same borrower is taking more than 2
Many of these lendings are happening off the record also. Yeah. Unfortunately, it's happening. So maybe going forward, we need to find the ways how these can be arrested. A lot of organized environment is getting created, madam. Of course, awareness, like the financial literacy programs are being carried.
That has to be focused on.
No, FLCs are there, financial literacy centers are there, which are maintained by the banks. And RBI has come out with the CFL, Center for Financial Literacy. Continuous series of literacy programs are being carried, or not to get into the trap, the credit trap. So of course it's a journey.
This one problem, we will probably be solved the next 1.5 years. A lot of policymakers have thought about this. This account aggregator framework, there is a discussion around real-time reporting if you take a loan, so that other fintechs and banks know that this person just took a loan from somewhere else. So that is a data and technology problem. Hopefully, it will get solved soon. Now, I totally agree with you. We should not be pushing loans onto people who can't afford it, and get them into a debt trap. The challenge with price caps is there are at the margin borrowers who can actually use that capital at that high interest rate for productive investments. If the borrower risk is high, the interest rate has to be high. How do we figure that out? In my view, price caps necessarily exclude some part of the people. It has some good benefits, but it has some cost as well. I don't have a solution. How do we prevent bad borrowing from happening while we don't have a price cap? Price caps, we know from our past, necessarily have hurted us in many ways. No, not just here, but in terms of drugs as well. But
I think that is where so much of data can actually help us segment so much better. So we build customized, I don't know, caps or
Tailor-made, yeah, I agree.
tailor-made policies for different segments of the
There are data provisions where we can share at what rate we are lending. It's 7%, how much is 10%.
Yeah.
Based on that, we can figure out at what percent major lending is happening in that particular institution. There, RBI is coming very heavily when it is lending is unethical or beyond the person's range.
Yeah. ULI
Sir,
they also
actually,
solve.
in fact, on the interest rate front, though RBI has not stipulated any ceiling, floor rate or the ceiling rate for advances or the deposits, but ultimately any bank while fixing the interest rate, there is a fierce competition for the interest rate. There is a competition. Suppose if I charge 8% on housing loan, and if Union Bank charges 7.5, obviously
People will
stand in the queue for UBI. So it's a fierce competition. The rates also will get adjusted within the shortest possible time. And any rate for the lending, more particularly for the loan, whichever bank fixes the rate, it is again based on the cost of funds for the bank. And ultimately what bank is actually getting is, if I charge 8%, bank is not getting 8%, it is only the net interest margin that we get. Yield on advances minus cost of deposit is ultimately the NIM. And that is required for running the organization.
Same with NBFCs.
Exorbitant interest rates, at least banks are not charging, public or private sector banks. There is a control, there is a check. Maybe some are charging 9, and for SHGs also, like some are charging 9, some are charging 9.5, some are charging 11%. In fact, just for updation, we had a special SLBC meeting on 6th of this month, sir, where Deputy Chief Minister, Honorable Deputy CM, he was there. He made an open appeal to all the banks. When SBI is, I think you were there, sir, CGM sir was there, UBA CGM sir was there. Why don't all the other banks match your interest rate for SHGs with the State Bank of India? We are charging 9%. I'm not saying SBI is doing the right thing, but when SBI is charging 9, let other banks also get it compatible with the interest rate for SHGs. But 2% also is very costly. So there is a continuous appeal, continuous monitoring, though there is a stipulated regulation from RBI about the interest rates.
So I agree with you, sir. I think ultimately competition will solve this problem. RBI has come up with this unifying lending interface. And the idea there would be, I as a borrower go and apply for a loan, providing whatever terms I need, what interest rate I would be comfortable borrowing at. And now that information is relayed to multiple banks in real time. And so they compete. And that will hopefully help us figure out the competitive interest rate, whether it's affordable or whether it is competitive or not. And maybe that will solve.
Now banks have to go for bidding of a customer.
Yeah, which is a good thing, I think. It empowers customers.